Research Affiliates founder and chairman, Rob Arnott.
Well, I think I'm the only one who stands between you guys and lunch at this point. What I'd like to do is to address the question, are valuations irrelevant? We keep hearing reports that Shiller PE doesn't matter, that we're at new, sustainable new high levels of valuation for very good reasons. This time is different. And it invites the question, valuations are irrelevant on a short-term basis. On a short-term basis, things can be priced at whatever level the market clears. Ben Graham famously remarked that the market is, on a short-term basis, a voting machine, and on a long-term basis, a weighing machine. And the weight of assets is determined by measures of valuation. What's it ultimately worth? One of the things that I think is just fascinating is how much investors leave on the table. I've made the observation at past forums that if a financial advisor adds zero value, that's a win. It's a win because most of our customers just are drawn, like with magnetism, towards doing the wrong things at the wrong times. If we go back over the last quarter century, the S&P 500 had a return of 8.97%. The average US equity mutual fund over that time, take the 4,000 funds that have existed in the last quarter century, and month by month, find the average return, and chain those together. You get 8.81%, 6 basis points away from the index. So much for the notion that you can't keep up with the market with actively managed mutual funds. On average, they do. Not necessarily during certain periods of time when you have growth-dominated markets like the last few years, but on average over a quarter century, they sure do. The average investor in these funds got 6.87%. Now, how is that possible? The funds are delivering 8.8, and the investors are getting 2% less than the funds are delivering. Well, the blue bar is the dollar-weighted return. It's weighted in accordance with how much money is in the fund. So as the fund performs well, beating the market, money pours in just in time for the periods of underperformance. And as the fund underperforms, money flees just in time for performance to turn. Growth investors are worse. The average investor gives up 2% a year. Growth investors give up 3% a year. And growth in general doesn't do as well as the market. Why doesn't it do as well? Because people are willing to pay a premium for growth, and a premium larger than the growth would justify, on average over time. They'll pay that premium because it's a more comfortable ride. Making money on Apple and Google is more interesting and more exciting and happier things to talk about than making money on some sort of disaster that is in process or poised to rebound. Value funds do better than the market. Value investors do not. They give up over 100 basis points per annum. So the average investor doesn't do very well. Giving up 200 basis points per annum, if we, in the financial services community, can help our clients just not do that to themselves, we're earning our keep with ample room to spare. Now, this sort of invites a question. If people flee when results have been disappointing, what if you do the opposite? How many of you would love to bring to your clients a very simple mechanism for beating the market reliably by 100 basis points per annum winning in 2 out of every 3 years? Show of hands. Yeah, it'd be very cool. Well, if you go to them and say, look, I've done a screen, I've looked at the 3,000 mutual funds that are available today, and I've found the 10% with the worst 3-year performance, and I'm just going to equally weight those 300 funds, you do 1% a year better than the market. Cool. Actually, it's closer to 1.5% a year. And it's buy and hold for 3 years, because that's for the next 3 years. Well, again, a show of hands. How many of you would comfortably take that proposal to your clients? I'm going to choose the worst performing funds. I'm not going to do any filtering on looking at management, on looking at what they invest in. I'm just going to take the bottom 10% and equally weight them. Of course you can't take that to customers. It's hopelessly uncomfortable to do that. Now, when we look at the market today, what's out of favor? Value. Value has had an 11.5-year bear market. Began with the quant crash in August of 2007, and through cycle after cycle since then, it's gone relentlessly lower. It's performed really badly. This graph shows the very simple performance difference, Russell 1000 value versus Russell 1000 growth, on a rolling 10-year basis. So we go back to 88, which really means 1978 to 88, that 10-year span. Value beat growth by 3% a year. 1989, 3% a year. 1990, 3% a year. Wow, this is nice. And it looks pretty reliable. Let's put it all into value in 1990, just in time for the 1990s, culminating in the tech bubble. Wow, what happened? Over the next 10 years, value underperformed by over 600 basis points per annum compounded. That was a time when I had pension sponsors saying to me, I never want to talk to another value manager as long as I live. Okay, great time to bail out of value. No, in fact, value snapped back ferociously over the next 7 years, had their best performance since the early 70s, and by 2007, when the cycle turned again and value started to underperform, value had beat growth by 6% a year, and keep in mind, 2007 includes 3 years of the tech bubble. So even including 3 years of the tech bubble, value had still outperformed by 6% a year. That means in those 7 years, it was outperforming by double digits. Where are we now? Growth has beat value by 4% a year compounded. What's the consequence? Well, one consequence is that investors are saying, I love the concept of value. I can't take the pain anymore. What else you got for me? I would posit that multi-factor investing wouldn't really have a big place in the marketplace today if it wasn't for this, for value performing as badly as it has over the last 10 years. And the reason I say that is that the messaging for multi-factor is value is a great factor. Like other great factors, it doesn't work all the time. You need multiple factors. You need to diversify your factor exposure. If you take in other factors, momentum, low volatility, quality, and the list goes on. If you take on other factors, spread your bets, you're going to have a smoother ride because they work at different times. And the consequence of that is because they all work eventually over long periods of time, the strategy is going to work. And because you're smoothing out the ups and downs over a 3 to 5 year span, you have near certain odds of winning, as if. We've written papers, one's coming out in the next issue of the Journal of Portfolio Management as the lead article, and it's Alice's Adventures in Factorland, which pokes a lot of holes through that standard narrative. It's not that we think factor investing is a bad idea, it's just that we think that it's oversold. The quant community has this wonderful knack of using back tests to build their models and to improve their back tests. If you use a back test to improve your back test, you better not believe that back test. And we have lots of folks in the investment community who do believe their back tests. Where are we now? Values underperform ferociously. And those who have, how many of you have been to look at our Smart Beta interactive website? Good, about a third of the room. If you haven't, you might want to take a look at it. Ben Johnson, who's head of research at Morningstar, listed it as one of his 7 favorite websites. He also listed Asset Allocation Interactive as one of his 7 favorite websites, so we've got 2 of the 7. Anyway, that website looks at strategies and factors and asks the question, what do we think the return's going to be over the next 5 years? We don't subjectively sit down and have conversations about what we think the return will be. We go back historically and we ask, what's the return been historically, and how much will trading costs take that down, and is the factor trading cheap or rich relative to history? If it's trading cheap relative to history, bring it on. Wonderful. If it's trading rich relative to history, you better mute your expectations. And the 3 dots at the top, that's the value factor, long value stocks, short growth stocks, in the US, in international markets, and in emerging markets. It's a trifecta. Those 3 are the most attractively priced, and we're expecting factor returns of 6 to 8% per annum compounded the next 5 years. Now that's for a long-short portfolio. It means that the long side of it, the value side, you should chop those expectations in half, 3 to 4% per year over the next 5 years. Net of trading costs, that's pretty cool. What's at the bottom of the list? You've got things like gross profitability. Let me see if the laser pointer works. Oh, there it is. Yeah. Gross profitability for developed economies, size for emerging markets, that's small cap and emerging markets. Small cap and emerging markets is trading at huge premiums to historic norms and huge premiums to large cap. Watch out. Size may be a great factor on average over the next 50 years, but right now in emerging markets you're paying too big a premium. This is one of the things that the factor community misses. They think quality proves itself over the last 50 years, adds value. Wonderful. But they don't pose the question, how much premium should I pay for high quality stocks? Quality stocks are always going to be priced at a premium. If I'm paying 20% premium to the market, that's probably a pretty good deal. If I'm paying an 80% premium, watch out. They don't ask that question. They say, it's a great factor, we're going to use it always, we're going to rely on it always, and yeah, it'll work sometimes and it won't work other times. Why not ask the simple question, do you think it's going to work right now at today's prices? That question is shunned. It's not even not asked, it's overtly shunned. And what do we find? Gross profitability quality in developed economies, we're forecasting 2.5% per year negative return. Do you really want to have that as part of your multi-factor strategy right now? Size in emerging markets. Small cap stocks are trading at a large premium to large cap stocks. Do you really want size to be one of the factors you rely on in emerging markets? Right now, what's cheap is value all over the world. That's cool. And by the way, this chart looks very different from how it looked 3 years ago. Very different. 3 years ago, this chart would have said there's several factors that are interesting. Diversify your bets. Right now it's saying it's time to rely more heavily on value. And more to the point, for those who are sick and tired of value underperforming, it is not time to say, let me move this over to a multi-factor because I can't stand the pain anymore. We often say past is not prologue. Well, it just isn't. When you look back at the last 145 years in U.S. equities, there's not many people in the room who remember those early years like I do, but it's a pretty good rate of return. It's 9% a year. Half of that is the dividend yield. 4.4 out of 9 is the dividend yield. What's this real fundamental growth? That's real growth in earnings and dividends over and above inflation. Now, has the economy of the US grown at 2% a year? No, it's grown at 4% a year, net of inflation, over the last 140 years. 4% a year. Why aren't we seeing that in the stock market? It's really simple. Macroeconomic growth is partly growth of existing enterprises and partly entrepreneurial capitalism, creation of new enterprises. That second part of economic growth we refer to as the 2% dilution. I wrote an article back in 2003 by that name, and you can't capture it in your equity investments. You can capture it in your venture capital investments, but then you're giving up on the other half, the growth that's attributable to existing enterprises. So you can't capture both in a single investment. You just can't. Equities have seen real earnings and dividend growth of 2% a year. We've seen inflation of 2.1% a year. That's right in line with current expectations for the coming decade. And compounding effects and valuation changes and so forth add another 0.5%, getting it to 9%. Okay, so think of it as half dividend yield, 1/4 growth, real growth, and 1/4 inflation. People will look at this and say, okay, 140 years, that's a long time. It's longer than most of us have been around. And it's long enough that it's a perfectly reasonable basis for shaping expectations for the future. Why should I expect 9%? Very simple reason. It's a different world. The growth is a little slower, and the yields are a lot lower. As of year end, the yield on the S&P 500 was 2.1%. Now it's back down to 1.9%. It's lower. Real fundamental growth, we're forecasting 1.3%, a little slower, but the US is no longer an emerging economy. It sure was 140 years ago. Inflation, we're using the consensus forecast of 2.1%. Add those three pieces together, and you've got a 5.5% return for US stocks. Not a lot of our clients will be ecstatic if we're delivering 5.5% before fees, before training costs. But that's what the market's priced to give you. If today's Shiller PE ratio of 30 plus is still 30 plus 10 years from now, what if it's not? On our website, the Asset Allocation Interactive website, we make a very simple assumption. Maybe it's a new normal. Maybe valuations will stay right where they are, or maybe they'll mean revert back to historic norms, which is about 17 to 18 times the 10-year smoothed earnings. Well, why don't we just split the difference, go halfway. If you go halfway back to historic norms, you're settling in at 24 times 10 years from now. That's still expensive by historical standards, so you're going from very expensive to a little expensive, and that shift alone costs you 2.5% a year, which brings you down to an expected return of 2.8, 0.7 above the rate of inflation. Now that's from the year end. From today's valuations, you could knock 20, 30 basis points off of that because valuations have popped again. So our forecast of returns assumes that past is predictive of future growth rates, but that dividend yield is a better predictor of future yield than the historical average yield, which is intuitively obvious. We all know that. And we assume that valuation matters and that we're going to mean revert. Even if you don't assume that, you're looking at 5.5% return for stocks, which is way less than most people want to assume. So we're assuming mean reversion. Why? Shiller PE ratio is powerful at forecasting long-term returns. It's lousy for market timing. This graph shows the Shiller PE ratio for US stocks on a log scale from 5 back in 1921 to 44 times back in 2000. That's a big range. And what does it tell us about the next 1-year return for US stocks? Does anyone see a slope in that graph? Not much of one. And yet, if you draw the regression line, you find it's actually a pretty steep slope. So yes, the Shiller PE is predictive of the returns over the coming year. It's just that the volatility of markets swamps that, so it's hard even to discern that there's a fit at all, and yet the fit's actually pretty good. When you look at 5-year spans, now the fit's starting to get pretty good. When you look at 10-year spans, it starts to get very good. And when you look at 20-year spans, it's not a whole lot better than 10-year spans. The dispersion's narrowed, but the slope is also flattening. What we find, and this is really interesting, is that every 10% change in the Shiller PE ratio affects the subsequent 10-year return by 1% a year. That's 10%, which means on average the market mean reverts over a 10-year horizon by the full amount of the dispersion away from historic norms, with some residual dispersion around that. So as we look at this graph, you can see if you look at today's valuation multiples of about 30, you're looking at a range from -3 to +8, with an expected return of around 3%. So the Shiller PE alone tells you roughly the same thing that our model for forward-looking returns would tell you, which is ramp down your expectations. US stocks are not priced to give you a lofty return. If you get 8% a year, which lots of people would love to expect, that's an extreme outlier on the high side. This idea of using the Shiller PE has been data mined thoroughly in the US. People understand how it works, when it doesn't work, and how uncertain it is. So we were among the first to say, okay, how about other countries? Now we've stripped out all of the dots, all of the individual samples, and just had the slope. And this is for 12 of the largest stock markets in the world. And take a look at those slopes. They're all in the same direction, meaning higher valuations point to lower returns, and all but one of them has roughly the same slope. Japan, you might think, because it had extraordinary valuations in 1989, and because returns were phenomenal before then and terrible ever since, you might think it would have a different slope, you might think it would have a different intercept, but compared with the US line, the Japan line's almost identical to the US line. It just has a different range. It's been higher valuations and lower returns. The only outlier really is Canada, where because of its heavy reliance on resources and the heavy volatility of resource prices, commodity prices, the valuations are less predictive of returns. But even there, it's a pretty strong relationship. The other 11 countries have all more or less the same slope. So yes, valuation matters. Yes, it's predictive of future returns for the patient investor, with a high degree of confidence and a certain amount of uncertainty around that confidence. Critics of the Shiller PE have some explaining to do. I don't know what that last little tick is on the green line. That appeared mysteriously since we put the slides together, so ignore it. The blue line shows the Shiller PE for US stocks going all the way back to 1926. And again, it's on an inverted scale. 4 means a very low Shiller PE and a very high earnings yield. We didn't get to 4. In 1932, we got to 5.5. Shiller PE ratio of 5.5 at the bottom in the Great Depression. The blue line dips very low in the year 2000. That's because the ratio was approaching 64 times. It actually got to 44 times. Critics of the Shiller PE have some explaining to do because the green line is the subsequent 10-year return for the S&P 500. The two are joined at the hip. Yes, there are cases where they depart pretty widely. Here's 1990, where you had a huge run-up in valuations, so stocks outperformed what the Shiller PE would have predicted, and you have other outliers on the downside. But broadly, these have a 70+% correlation. The correlation is tremendous. Yes, valuations predict long-term returns. Today, they're predicting a lousy return. 10 years ago, they were predicting a wonderful return. What have we had in the last 10 years? A wonderful return. What are we looking forward to in the next 10 years? Sadly, not much. Now, there's a lot of other ways to measure valuation. So people will say, I don't really trust the Shiller PE because it's based on smoothed earnings, and that includes the year 2009 when earnings went almost to zero. So what about other measures? You can look at Warren Buffett's favorite measure, market cap to GDP. That's the green line. You could look at Tobin's Q, the replacement cost of the infrastructure of business. That's the gold line. You can look at the Hussman's PE. That's price relative to the highest earnings of the last 10 years. They all say that the market is somewhere between 70 and 100% above historic norms of valuation. That doesn't mean the market's going to crash back down to historic norms. It also doesn't mean that it won't crash all the way back to historic norms. What it does mean is ramp down your expectations. The only path to lofty returns from current levels is for valuations to soar from top decile multiples back to top percentile multiples. That's a pretty darned aggressive assumption. Now, there are other things that drive valuation that can allow markets to stray from long-term historic norms. We did a paper, my colleagues did a paper, in which they looked at macroeconomic volatility, that's the blue line, and the Shiller PE ratio, the green line, and they found that valuations tumble when macroeconomic volatility is high. You can see macroeconomic volatility very high in the Great Depression and World War II. Valuations, the green line, inverted scale, was towards the top of the graph, which means valuations were low. The economy got more and more stable through into the 1960s. The volatility of the economy, the blue line, got very low, and valuations, that line came down, which means valuations went high. And then in the 70s, volatility returned, and then in 08, 09, volatility returned. But the linkage here is really tremendous. What is that volatility measure? It's the 3-year standard deviation in CPI inflation and the 3-year standard deviation in GDP. Two really simple measures, average those two, that's your macroeconomic volatility, better than a 50% correlation with valuations of markets. So low volatility means the market's not extraordinarily overpriced for a very stable economy, which is what we've got. The fly in the ointment there is that the economy is very stable until it's not. When economic volatility returns, the natural valuation level will go down. So where are we as of year end? We were at 28.8 as a Shiller PE. It's back up to 31.5 now. So we're back up to nosebleed levels. But even at year end, 28.8, you had folks saying, yeah, but that includes 2009. Terrible year. Well, that's the point of a Shiller PE. You're supposed to include peak years and trough years. So let's take out the best year and the worst year. Now you're looking at 27. Let's take out only the worst year. Now you're at 26. And once again, that's popped back up to 29. So right now, you're back up at 29 times, even if you leave out 2009. That's not cheap. Take the average for the last 90 years, it's 18. Average over the last 140 years, it's 16.5. Average over the last 40 years is 21. This is what Jeremy Grantham pointed to a little over a year ago when he said the market could have a melt up. It was interesting hearing a contrarian say the market might have a melt up. I agree with Jeremy. 80% of the time, I didn't agree with him on that one. Adjust for the stability of the business cycle, and we show a fair value of 22. There's still a 20% drop needed to get you to those levels, and that's only if the business cycle remains nice and stable. and that was from year-end levels. From current levels, it's more like a 30% decline. So we're looking at a market that is expensive. It doesn't mean it's going to crater, it just means it's expensive. Now, people will say, yes, but U.S. has monopolistic pricing in global trade. Look at Google, Apple, Facebook, and so forth with their global reach. The U.S. has therefore got sustainably higher profitability measures, and therefore valuations should be higher. No, valuations should be higher if the sustainable growth is high, not if the sustainable earnings are high. High earnings already factor into the valuation because valuation times the earnings times the PE gets you there. So if the earnings are high, you're already justifying higher prices but not higher multiples. And what do we find? We find that historically there's an inverse relationship. When earnings growth has been extraordinarily high, then watch out. Where are we now? 10% growth per annum over the last 10 years. And what's the historic range of subsequent earnings growth over the next 10 years? The next 10 years subsequent growth has been anywhere from -1 to +3% per annum over the next 10 years. Those who are saying don't worry about the 2% the 2% dividend yield, you're going to get 8% from growth. No, from current levels where growth has been stupendous, you can expect -1 to +3, averaging about 1% growth in earnings per year over the next 10 years would be what history suggests is a reasonable expectation. That's worrisome. If the growth isn't there, the valuations are too high. Now, those of you who've been to our asset allocation website are familiar with the fact that we see the U.S. as an outlier. I've often been called a perma-bear. I'm a bear when things are expensive. I'm a bull when things are cheap. There's a lot of stuff out there that's cheap. You look at this graph and you can see a big cloud where equity markets around the world are priced to give you anywhere from 5% to 10% annual returns over the next 10 years. That's a nice range, especially the high end of that range. And U.S., large and smaller, are outliers to the downside. They're outliers because they're expensive. Russia's an outlier because it's cheap. Our model says 15% per year return for Russia with enormous volatility. And that's based, as is our U.S. forecast, on yield, very high, historical growth rates, moderate, and mean reversion in valuation. It's at half the historic multiples, going halfway back to historic norms, adds about 6% per year compounded over the next 10 years. That's cool. But there's no Putin component. That model doesn't have a Putin variable. And if Putin decides, I don't like sanctions, I'm expropriating all foreign shareholder wealth, then you just got a minus 100% return. So the bottom line is, this is a model. It's imperfect. It leaves some things out. And do I like owning Russia? Yeah. Do I want to have half of my portfolio in Russia? Heavens no. But it's only 3% of MSCI's emerging markets index. What's the harm in holding 5% or 7% of your skinny EM slice of your portfolio? If you've got 10% of your portfolio in emerging markets, you're not even at a 1% position in Russia. That's okay. But most important thing to observe on this graph is U.S. is an outlier, and there are lots of stock markets that are priced to give you 7, 8, 9% annual returns. Stocks are not expensive worldwide. They're expensive in the U.S. and a handful of other markets, none as much so as the U.S. I'll skip that in the interest of time. Now, speaking of valuation, let's drill down within the stock market. The largest holdings of index funds, how do they do? Not very well. With index funds, if a stock price doubles, its weight in the portfolio doubles. Simple truism. Another simple truism, a sensible investment strategy would put more money into what you think will perform better and less money in what you think will perform worse. Does that mean that with cap-weighted indexing, you're tacitly assuming that returns will be higher after the price doubled than you thought before it doubled? Well, yeah, actually it does imply that. Is that sensible? Heavens no. Is it consonant with efficient market hypothesis? Actually, yes, it is, which is one of the many reasons that I think EMH is flawed. But what we do find is that the largest holdings of index funds do impact performance, and not in a pretty way for the patient long-term investor. Sure, as long as the popular beloved companies soar, while they're soaring, they're wonderful. But eventually they don't soar, and eventually they're supplanted by other new up-and-comers that crowd them out. And unfortunately, with cap weighting, you have maximum exposure in a company when it peaks. Let's go through a few examples. People talk about the FANG stocks. We have cleverly renamed them the FanMag stocks by adding 2 stocks to the list. What's the market cap of the FanMag stocks? Well, that's about $3.25 trillion. Where was it at the peak earlier last year? It was a little over $4 trillion. That's a lot of money. That ranks behind the US stock market at 21 trillion and the Japanese stock market at 5 trillion, and only behind those two. FanMag's 6 companies are worth more than China, more than all of Britain, more than any other country's stock market in the world other than the US and Japan. Is that sensible? Yes, if these stocks turn out, all of them or most of them, to be massive winners on the scale that is baked into their current share price. And only if that assumption is true. If you compare it to sectors, you find financial sector and healthcare are the only sectors that are worth more than the 6 FanMag companies. Ironically, the FanMag companies are worth more than the entire technology sector. How can that be? Because some of them aren't categorized as technology. Amazon is not a tech company according to sector categorization, nor is Facebook. So if they were in technology, of course they wouldn't be bigger, but they are because not all of them are counted as technology, even though really that's their business. How much do things move around? The companies that are most popular, most beloved, and most valuable in the world. At the start of 2019, you had Microsoft, the most valuable company in the world, eclipsing Apple for the first time in quite some time, then Amazon, then Alphabet, then Berkshire Hathaway, then Facebook, Tencent, Alibaba. 7 of the 8 largest market cap companies on the planet are tech darlings. And yes, I'm using the word tech liberally to include consumer companies like Amazon. Yeah, it's a tech company. So as we go back historically, we find there's a lot of rotation. The top darlings of this year aren't all going to be top darlings next year. Most of them won't be top darlings 10 years from now. The lion's share of them won't be. Why do I say that? Because that's always been the pattern. Go back all the way to 1980. What do you find in 1980? You find IBM, AT&T, Exxon, Standard Oil, Schlumberger, Shell, Mobil. Oh my goodness. Firstly, they're all US companies. All of them, no exceptions. Oh, I take it back. Shell, European company. All but one, US companies. Half of them are energy stocks. This was the oil bubble, the energy bubble. 10 years later, the ones marked in red are marked in red for the simple reason that these companies weren't on the list 10 years later. That's 8 out of 10. 2 of the 10 most darling stocks in 1980 were still on the list in 1990. 8 dropped off the list, which means 8 of them almost certainly underperformed the ACWI index, underperformed the world market. 1990, you had a totally different list. NTT, Bank of Tokyo, Industrial Bank of Japan. Is there a common denominator here? Well, gosh, 8 out of 10 are Japanese companies. It was the Japan bubble. Japan was going to dominate the world economy. Did it? No, but it actually did continue to grow relative to the world over the next 5 years, even as their stock market was cratering. And of those companies, how many were left? Well, the ones in yellow are kind of interesting. Those are flip-flops. They weren't on the list the previous list, and they aren't on the list the subsequent list. They appear, they're flash-in-the-pan winners that are gone 10 years later. And so what do you find? You find 2 of them are still on the list 10 years later, NTT and IBM. That's it. And, NTT and Exxon. The year 2000, what do we find? Microsoft, GE, NTT Docomo, and so forth, the peak of the tech bubble. 7 of the 10 largest market cap companies in the world are tech stocks of one sort or another. Roll the clock forward to 10 years ago. We start doing year by year starting 10 years ago. So roll the clock forward to 2009. How many of the 10 in 2000 were still on the list in 2009? 3. 3 survived. Microsoft, GE, and ExxonMobil, 7 were gone. By the way, peak of the tech bubble, if you take the 10 largest market cap, most beloved, most popular tech stocks at the start of the year 2000, how many of them had positive returns by the end of the year 2018? 4. 6 had negative returns. On an 18-year basis, 6 had negative returns. How many of them beat the S&P 500 over that span? 1, Microsoft. That's it. 9 out of 10 underperformed the market, 6 out of 10 had negative returns. Watch out for these darlings. Now, as you get down to year by year, you see much more continuity, much more companies that aren't marked in green as newcomers or red as companies that fall off the list or yellow as flip-flops. That's a much more steady list. And yet still, every single year, on average, 3 of the top 10 darlings are gone from the list 1 year later. 1 year later. That's how fast the list changes. So we did a little study looking at largest market cap, most beloved companies, and we looked at a couple of different types. The average largest market cap stock in each sector in each of the G8 countries. What do we find? We find that on average, 44% of them win over the next year, beat their sector over the next year, but only 34% win over the next 10 years. And the average return is 5% below their sector over the next year and 5% per annum compounded below their sector in the next 10 years. Now, if you narrow your focus to the largest market cap stock in the world and look at that one, over the next 1 year, less than 40% of the time, only about a third of the time, a little over a third of the time, do you find that the largest market cap stock in the world beats the market over the next year. 60+% of the time it underperforms. On average, it underperforms by 1,200 basis points in a single year. Does that mean it corrects and then stops? No, it keeps going. It underperforms by 10% a year compounded for the next 10 years. There's only been one time when the number one stock managed to beat the market over the next 10 years. Once out of the last 40 years that we studied. So we decided to create some model portfolios. What if you wanted to create an index fund that could beat the index funds? Not that hard to do if you're patient. The graph on the left shows you the performance of the developed world index, the MSCI World Index, and then shows you the performance of the global top dog stock. If you had a concentrated portfolio invested just in the number one most beloved company in the world, and every time that changed, and it was bumped out of the way as Microsoft recently bumped Apple out of the way, you change, you sell your Apple and you buy your Microsoft, always staying with the most beloved darling. Well, the MSCI World Index gives you 20 times your money over the next, excuse me, is that right? No, 32 times your money over a 37-year span. So 37 years, you make 32 times your money. That's a pretty cool rate of return. If you invest in that number one darling, you have the same amount you started with 37 years ago. That's it. And if you invest in the global, if you invest in the global top 10, the 10 most beloved stocks on that list that we were just looking at, you wind up with 8 times your money, 1/4 as much as you would have had with the market. And if you invest in just the number one stock in each of those 8 countries, same basic result, 8 times your money, 1/4 as much as you would have had by owning the market. So performance relative to the market, pretty relentlessly down. What you see here is Apple first coming on the list and actually doing just fine until it gets bumped off the list. But that's obviously an outlier. That's not the historic norm, and Apple has now been bumped off the list. So let's suppose we decide to buy the MSCI World Portfolio. As with the previous graph, that's the gold line. Let's say instead of shifting to those darlings, let's say we exclude those darlings. Now you're starting to pick up return. If you just exclude the number one top dog in the world, your return goes up by over 20 basis points per year, and your risk does not go up. If you exclude the number one company in each country, your return goes up 35 basis points and your risk doesn't change. If you exclude the top 10 in the world, your return goes up 46 basis points per annum compounded, and your risk does not go up. What does happen is that your tracking error is not small. You're adding 46 basis points, but you're taking on 119 basis points of tracking error. That kind of tracking error would be deadly to the indexing community. But you could simply chop in half your holdings in these companies, and that tracking error comes down by half and becomes more palatable. Bottom line is, if you want to beat the index, it's not that hard to do so if you're patient. You'll notice these lines don't go up nonstop. They go up and down. There are periods of time when it doesn't help you. The final takeaway in a world in which the US is an outlier on the downside is that there's lots of asset classes that are attractively priced. Those of you who sat in on the PIMCO presentation this morning saw our graph of what we call third pillar markets and how those are priced just equally weighting across all of the various third pillar markets, the diversifying markets outside of mainstream stocks and bonds, equally weighting them. We're expecting a 4% real return, a 6% notional return. If you're at all tactical about it, if you choose to ignore the diversifying markets that are fully priced or worse, you can actually take that up 1 or 2% very easily. So this graph looks at US 60-40, global 60-40, and then a whole host of diversifying markets outside of mainstream that most people use comparatively little and that many investors ignore. TIPS, bank loans, high yield, commodities, REITs, emerging markets, currencies, local currency debt, emerging market stocks. Equally weight all of those, and you wind up with 1.5% higher return than global 60-40 with the same risk. A little higher risk than US 60-40. Leave out the worst of these in terms of forward-looking rates of return, and you can easily bump that up another 1.5% to something around 7%. It's not hard to build a portfolio that'll have very respectable returns. Unfortunately, today that means a lot of maverick risk. It means a lot of risk from departing quite far away from what most people consider the safe haven comfort zone of domestic stocks and bonds. So our key takeaways are simple. The link between starting valuation and subsequent returns is powerful. It does require patience. It's not useful for picking tops and bottoms. And chasing returns, which everyone does, is very costly. It costs the average mutual fund investor, 200 basis points a year. If financial advisors merely counsel their customers well enough to discourage them from performance chasing, from pouring more money into whatever's performed best, and from yanking money out of whatever's performed worst, and recovers that 200 basis points, you don't have to add alpha. If you're just saving them from their own worst instincts, you've added 200 basis points. Over-rebalancing into laggards, as uncomfortable as it is a wonderful long-term performance-enhancing strategy. If you find a strategy that you love, that you think makes great sense, and it's performed badly over the last couple of years, rebalance into it. Don't walk away. It's a wonderful way to add some returns. Across asset classes, there's a lot of markets that are sensibly priced. Some markets are even cheap. Unfortunately, today, mainstream US stocks and bonds are priced to give you less than 1% over and above inflation on a 10-year look-ahead period. Now, that tells us nothing about what US stocks will do this year, but it does say, watch out, in the coming 10 years, you're liable to be disappointed. And within equities, all over the world, value is the only factor that's trading really substantially cheap relative to historic norms. This is not the time to say, I'm tired of value lagging, get me out of here. This is a time to say, I got to stay the course here, and if I can possibly encourage my clients to show the courage to do so, maybe even ramp up. Just as an aside, I have a little over half of my personal liquid assets in emerging markets, deep value stocks. Okay, I don't have a committee to report to, and I'm not likely to fire myself, so that's not a portfolio that I would recommend to the average investor because they won't have the staying power. But it does show my confidence that valuation really does matter. And when it comes to indexes, you're maximizing your exposure to an asset just before it turns south. Why would you want to do that? We talk about rebalancing in asset classes. Why not rebalance within the stock market? That's all fundamental index does. It's not, fundamental index doesn't win because of the fundamentals, it wins because of a long horizon mean reversion, because of contra trading against the market's biggest bets. Harry Markowitz at one of our events remarked the investment markets provide two free lunches, diversification and long horizon mean reversion. Most people don't avail themselves of either free lunch to nearly the extent they should. And as for long horizon mean reversion, most people run the other direction. Thank you all very much for your time. We have about 7 minutes for questions. We've got a microphone here. Oh, okay. Yes.
Hi. So when you look at value over the last 10 years or so, part of the reason it's underperformed, it's based both within the stock market and across countries. Exactly. It's basically been, long energy, short technology, and maybe even long other things, other like sort of sin stocks like tobacco and alcohol. And we've been told, yesterday that we can avoid these sort of stocks and not have to pay any penalty for it. And of course, Cam told us we're all going to upload our brains into the matrix or something like that. So, given those other concerns, do you think part of value's troubles can be explained by these concerns about stranded assets or other more secular long-term changes? And if we look at value on a more sector-neutral basis, does it still look as cheap as it does in your graphs?
That's several questions in one. Let me try to take them each. Firstly, let's talk about the sector. If you look at value on a sector-neutral basis, it is still trading cheap relative to history, but not as cheap. If you look at why value underperformed over the last 10 years, part of it is that value has pulled you into sectors that have struggled, like energy, and out of sectors that have performed brilliantly, like technology. But that's only part of it. The other part of it that's huge is that the valuation assigned to the growth stocks has risen relative to the valuation assigned to the value stocks. That's mean reverting. The difference in earnings growth might not be mean reverting. The earnings growth on the tech companies has been pretty darn good. And that might not be mean reverting, but the valuation spread between the two has widened considerably, and that's the mean reversion we're looking for, not not that all of a sudden energy will be wildly profitable and tech wildly unprofitable. The other observation I'd make, and this is a lesson reinforced by the tech bubble, is these tech companies that are dominating the top tiers of stock markets all over the world today, they're not all going to win. There's going to be some big losers there. The ones that win, the question is the magnitude of win that they're going to have already discounted in the price? Are you prepaying for all of the good news that is likely in the winners, let alone the future prosperity that isn't going to happen in the losers? So I would venture to say that of that top 10 list, there's going to be 2, 3, 4 of them still on that list 10 years from now. Does that mean I want to invest time and effort to choose which of the 10 I want to hold? Or does it mean I want to just say, I'm inclined to underweight them all because I don't know which ones are going to be the winners? I lean towards the latter choice, but the former choice is a perfectly legitimate one for somebody who wants to do that kind of digging. Next question?
Yes, Rob. One of your first slides was showing the prospective returns of factors given their valuation, and the labels were very faint and difficult to read. If you wouldn't mind pointing some of those prospective returns out.
Yeah. Do you guys have binders with all of the slides? No. They're probably available on our website. And if they aren't, ask folks here to send them to you, and they'll, I'm sure, be happy to do so. Oops. Let's go back to that slide. Okay. This is the graph you were referring to. The labeling is very faint for a reason. The reason is that the value factor is the extreme outlier, and we were just drawing attention to that. But you have value based on price to book, the simplistic old version of value here for developed economies, for emerging markets, and for the US. On a price to book value basis, value is not terribly cheap by historic standards, and so doesn't look all that brilliant. Investment, which is Fama and French's newest factor published half dozen years ago, which is a misnomer. It's really how much does the company allow its book value and assets to grow. The more it allows them to grow, instead of distributing them out to the shareholders, the worse. So I think a better name for the variable would be anti-investment. But liquidity, in emerging markets, you get a premium return for liquidity, but not in the US. Illiquid stocks are very fully priced in the US. So the labels are deliberately faint, but the basic message is it doesn't matter which factor you're looking at other than value. The return expectations are not likely to be brilliant. For value, it's unusually cheap. The spread between growth and value is unusually wide, creating an interesting opportunity. Next.
Yes. Hi, Rob.
Hi.
Could you talk to some of your competitors speak of the difficulty of timing factors based on valuation?
Yeah. I wrote a paper 3 years ago entitled How Can Smart Beta Go Horribly Wrong? And it stirred rather more controversy than I expected. It was actually kind of fun to watch. Let's suppose I'd written a paper entitled How Can Stock Picking Go Horribly Wrong? And I postulated a very simple idea. If a stock price has soared and the underlying fundamentals haven't, its past return will look brilliant and will not be at all predictive of the future. And if there's any mean reversion on valuations, watch out. If I'd written that paper, people would have looked at it and said, what's this moron talking about? Everybody knows that. But by saying exactly that message about factors and strategies, all of a sudden it was controversial. The notion that factor timing, I never advocated wild factor timing where you put all of your eggs in one basket. I never advocated the notion of making big bets on small signals. So one of the more vocal critics was Cliff Asness, and he set up a straw man saying, you shouldn't make big bets based on small signals. You shouldn't concentrate your portfolio narrowly. I never said that. And he and I are actually in very strong agreement on the ways in which one should make limited bets, careful bets, scaled bets that are big only when the signal is unusually large. But there's a complete naivete in saying quality as a factor is a brilliant factor. You should always rely on it, and you shouldn't look at how much you're paying up for quality. Quality stocks will always be priced at a premium. If you're paying 20% premium for a high quality portfolio, you're probably just fine. You're probably going to earn a great incremental return. You'll probably beat the market. If you're paying 80% more, watch out. You're overpaying. And the same thing applies to all of the factors. Mid-2016, I made note of the fact that low beta stocks were priced at twice the valuation multiple of high beta stocks. And I suggested that low vol strategies might be in for a dangerous period because they'd never been priced at twice the valuation of high beta stocks. Roll the clock back to the peak of the tech bubble, and it was the other way around. High beta stocks were 3 times the multiple of low beta stocks. So firstly, going from 1/3 the multiple of high beta to twice the multiple of high beta, of course the 15-year returns were fantastic. It didn't mean they were predictive. It just got more expensive. And sure enough, over the next 6 months, low vol strategies went down in an up market, underperforming the market by 1,000 basis points in 6 months. So yes, smart beta went horribly wrong. I'm an advocate of having broad diversification, and apropos of Harry Markowitz's observation, 2 free lunches, diversification and long horizon mean reversion. Make modest bets favoring the markets that are, and strategies and styles that are priced cheap relative to history, and reducing exposure or eliminating exposure to those that are trading unusually rich relative to history. One other quick example, suppose I came to you and said, have I got a strategy for you? I've identified the 100 stocks in the US stock market with the best performance over the last 15 years. And I'm equally weighting that portfolio. And look at this simulation, this back test. It's astonishing. Everyone in this room would throw me right out. And that's exactly the argument that's being made in factor space. Look at these factors. They perform brilliantly. And I've cherry-picked them because they perform brilliantly. And because they perform brilliantly, you can count on them into the future. Bunk.
Hey, Rob, thanks again for putting on this symposium. It's great. Quick question or just a thought on, we just had the gentleman speak about ETFs. I mean, ETFs and passive investing are taking over.
Yes, they are.
The majority of those are market cap weighted.
Correct.
Do you think that is playing into what we've been seeing the last 10 years?
I think it absolutely has been a contributing factor to the dispersion in multiples and the dispersion in valuation between stocks that are members of those indexes and stocks that aren't. Look at when Twitter got added to the S&P. Between 1 week before it was added and 1 week after it was added, it rose 25%. There was no news other than being added to the S&P. That's a huge premium. Now, does that premium stay? Yeah, for the most part it does. But one of the studies we did showed that the new additions to the S&P subsequently underperformed by about 2% over the next year. And the ones that are dropped to make way for those newcomers subsequently outperformed by 2,000 basis points. So you want an interesting strategy, buy the stocks that have just been removed from the index. Kind of a cool strategy. It'll be bad on diversification, but as a small niche strategy, it's kind of cool.
Thanks, Rob. What are your thoughts on the end game of your most popular stocks, the new shareholder on the block, central banks with printing presses?
Yeah.
What's
yeah.
the end game on that?
Oh gosh, I sure hope it's not Japan's end game where the central banks start to be the dominant owner of the whole stock market. One of the things that's often overlooked with Japan, and this is interesting, is that the government debt to GDP there is of course astronomical. It's closing in on 300% of GDP. The debt that's not owned by the central bank is now under 100% of GDP. It's among the lowest in the developed world. It's really interesting. So they're basically saying, to stimulate this economy, we're going to be buying assets of all kinds and using them to stimulate. Stimulus doesn't stimulate. Even Krugman says stimulus has never stimulated on a long-term basis, but it's not been tried heavily enough. Give me a break. So I don't know what the end game is. I do think we're going to have a recession somewhere in the next 2-3 years. And I think when we have a recession, the US has some ammunition to cut rates and basically seek to counteract the recession. Europe doesn't, Japan doesn't. And so I think that it's going to be ugly. I think there's a decent chance that Europe's already in recession right now. And so if there's a risk of US recession in the next year or two, it's liable to have come out of Europe. And it's because of these stupid experiments. They think that going to negative interest rates is stimulating renewed inflation, stimulated renewed economic activity. Absolutely not. It's signaling panic. And by signaling panic, it's telling everybody time to hoard, hunker down, stop spending, and brace yourself because our government leaders think something horrible is about to happen, so we better brace for it. It's destimulating. Lowering interest rates is stimulus until you reach a threshold where it starts to signal panic. And then it's anti-stimulative and it's deflationary. And we've got central bankers all over the world who just don't get that. One of the best writers on this was a guy named Knut Wicksell back in the 19th century. I asked a central banker at one conference, what do you have to say about Knut Wicksell's work on natural interest rates? And he said, nobody pays attention to him anymore. Just dismissive. I'm sorry, the guy's models are very simple. If interest rates are too low, you get malinvestment, and there's a penalty to be paid for malinvestment and slower growth. If interest rates are too high, it stifles the economy. There's a sweet spot. There's a Goldilocks interest rate that's slightly above the rate of inflation, slight positive real rates, and nobody believes it. It's scary. It's a non-answer to your question. I don't know how it's going to play out, but...
Well, I don't think they're buying the value stocks.
No, no. And the question that an investor should wonder is, if a stock is trading at 10 times earnings, can it absorb those shocks better than a stock that's at 50 times earnings? I would say probably yes, unless the stock at 50 times earnings manages to bull its way through the economic tumult and continue to grow, or the value stocks crater and go to zero. Well, they're not all going to go to zero. Thank you all very, very much for your time. Oh, we have one more. Yes.
Yeah, hi, Rob. The high Shiller PE today and the low expected return, how do you think about the relative contributions that might come from valuation versus margins? And how has that tended historically at similarly high levels?
Well, historically, you do get mean reversion, and it tends to play out with about a 10-year half-life. So it tends to mean revert on that pace, which basically means if you're 60% above historic norms, you should expect to lose about half a tenth of that per year would get you back to historic norms. Half of that would cost you about 3% a year. That's a reasonable assumption with big uncertainty. So if you take our methodology and go back and ask how well would this have forecast 10-year returns historically, it's a good predictor plus or minus about 4%. So when we say 0.5% real, our tacit range is it could be 4.5 real or it could be minus 3.5 real. That's not an exciting range. With emerging markets, we're looking at 7.5 real, hence 3.5 to 11.5, and with value, another 3% on top of that. I would say we've got 80 or 90% odds that emerging markets value will beat US stocks over the next 10 years. My confidence over the next 1 year is much lower. Thank you all very, very much for your time.